income you've had, gross. So your capital gains tax is that on top of that, all of that is going to be taxed at 24%.
Okay. Yeah, life will get hard soon.
Yeah, so that's capital gains tax. You have your exemption, you pay your tax rate. Now, a bit different with property because you've got this one large asset you can't split into different parts and you can't chop that up. But for someone with a stocks and shares portfolio, and you can sell units of stock or you can sell certain stock and hold some stock back, you can be really clever. So one thing we do, or we work with investment managers that do as well, is we can be really efficient in how we sell down assets.
Right.
So you can sell assets that have a loss to offset against gains. Okay. So that's one way that you can help control an out of control realized gain. You can also, because you can do it in parts, you can do partial sales at different times, you can straddle tax years, or you can spread sales over a number of tax years so that you can, because your exemption resets every tax year.
What if you have an asset that is it's due for sale right now? The fact that it's
well, if it's a property, like I said, you can't spread that over tax years.
Yeah.
That's a one-time sale, and the date is what the date is. But I'm saying if you have a portfolio of a number of different stocks and shares, and we do it a lot, where we're trying to, if we want to use that for a different purpose and we need to sell it to reinvest it elsewhere, we can potentially do that over a period of time. So if we can do it over 2 tax years, we will, because we can halve the tax liability by doubling up on the tax exemptions.
But the way the stock market can be volatile, would that mean that they could be selling at a great gain right now, but also be selling in a year's time at possibly at a loss?
Mm-hmm.
Okay.
So very much a situation of sometimes you don't want to let the tax tail wag the investment dog. You don't want to let something that might be less of a problem dictate something that could be a bigger problem.
Yeah.
So yeah, for more volatile asset classes, you might want to think, well,
pay the tax.
Exactly, because capital gains tax is also one of those taxes that, I guess to Gary Stevenson's point, it's a tax on growth. It's not a tax on the underlying initial investment you made. It's only a tax on the growth of that investment. So it's not the worst tax in the world to pay.
Yeah.
If your investment's done very well, you get to keep most of that growth, and obviously you get back your initial investment as well. It's just a margin of the growth that you've got to pay in tax. Another thing that we do, particularly with married couples, is if one of them owns the asset class, or the asset, it might be a property or stocks and shares, is you can share ownership, or you can gift half of that asset to your spouse. So that doesn't incur capital gains tax, gifts to spouse. But each of the spouses have capital gains tax exemptions. So you can double up on the exemptions.
Yeah.
So if you have a married couple that you can utilize, and you're close to a new tax year, you could effectively quadruple the amount of exemption that you would have if it was just yourself, by firstly giving half of it to your spouse and then separating it over 2 tax years. And then all of a sudden, instead of just having £3,000 of allowance, you've got 2 of you, 3,000 times 2. And if you can do it over 2 years, you've got 4 lots of exemptions.
And on top of that, you'd be able to get the lower bracket of the tax that you'll pay because
you're only applying half the gain to yourself.
Yeah.
So if you've got 2 people that are earning £30,000, then you've got £20,000 headroom for both of you. You've got £40,000 worth of headroom at 20% tax compared to just 20, and then potentially 40% on the above that.
Doubles as well.
If what, sorry?
So over the 2 years, because obviously if you was to quadruple it, that would be over 2 years, right?
Exactly. Yeah.
Okay, yeah, that sounds good.
So yeah, it's just to come back to what Gary Stevens was saying is
what do you say his name? I'm sure he's a content creator.
Yeah, he is. Yeah. He's bald, got no hair, and
he just sits at a table.
Sits there with his trackies and his socks tucked over his trackies. Yeah,
you're talking about.
Yeah. So his thing is, compared to income tax is where you're taxed on what you earn. So if you're employed, it'll all be done for you through PAYE. Your payslip will come through. It'll tell you what you've been taxed. And that's where you get your 0% up to personal allowance, 20% up to 50,270, and 40% above that up to 125, and above that's what, 45%. But if it's through earned income, you've also got national insurance to think about. It's a pretty stealthy tax because most people know, a lot of people know what the income tax rates are. You think like 20%, 40%.
Yeah.
But actually, those two tax rates are a lot closer to each other than most people realise. Because actually, if you're employed, you're paying national insurance at 12% on your income up to £50,270. So your 20 plus your 12, your total tax rate's 32%. But once you get to the 40% income tax category, your national insurance drops to 2%. So you're paying 42% compared to 32%. So instead of there being what most people assume is a 20% gap in income tax, it's actually only a 10% gap in total tax.
Okay.
So it's a lot closer than most people really realise. And you can't just ignore national insurance because you've got to pay national insurance contributions.
Self-employed as well?
Well, self-employed is a bit different. Self-employed, you make your national insurance contributions via a different class. And you can control the amount of income that you will kind of attribute to salary.
Okay.
Now, if you're self-employed through your own limited company, you can keep that salary very, very low up to the threshold that means that, right, you've qualified for national insurance contributions, but you're not paying yourself any more of a salary than you need to, so you can keep that really, really low. And then you can pay yourself dividends on top of that, which don't incur national insurance contributions. But you would pay corporation tax on those dividends. So you've got different kinds of taxes to consider there. But yeah, national insurance contributions are not something to ignore. And for employers, it's becoming more and more expensive. Like they're paying 15% now on all income.
Okay.
So regardless of whether you're a base rate taxpayer, higher taxpayer, employers pay your salary plus 15% employer contribution. So it's chunky. And this is where, again, we do an awful lot of pension planning around this, because if someone's earning a salary that is creating a surplus of income, through salary sacrifice, you can reduce that level of income, effectively give it up, which one of the downsides there is it might reduce your benefits like life insurance that might be attached to your salary that you earn, plus also how much you can borrow, how much you can lend from mortgage providers, for example, because your salary is going to be what that's tested against. So if you are reducing that, be aware that that could have an impact on that. But the benefits are, let's say you earn £80,000 and you've got £6,000 a year worth of surplus income. It's about £500 a month. That's your net income. So if you reduced your £80,000 down to £70,000, that's your £10,000 net of that, not accounting for national insurance contributions, is £6,000 after you've paid your 40% tax. So by saying, don't worry about that surplus income, I'm going to put that into my pension instead, by reducing